Hello, this is Prof. Aram, and in this video, we will go over the next category of ratios, which are the profitability ratios. So let's get to it. Profitability can be assessed in a number of ways because the appropriate measure depends on the specific questions being asked, right? For example, when you compare your numbers to cells like this, right? These are representing margins. And when you compare your numbers to shareholders' equity, like here, your profits over shareholder equity, they represents return to shareholders. Okay, so let's look at the first one. For example, net profit margin. Uh, in this one, after subtracting all the costs from your sales, after you're subtracting all the costs, including operating, financing, and taxes, you're looking at how much is left to the shareholders of the company, or how much is the profit, right? How much is your net profit per dollar of sales that you generated for the firm. So if you're, for example, your net profit margin is, I don't know, 8%, that means that for every dollar of sales that you've generated, your shareholders have 8 cents in accounting profit. Okay. The next one is the return on equity, or ROE, of the firm, which is the net income over the shareholders' equity from the balance sheet of the firm. So this is the book value of equity. So this measures the annual return the shareholders earn, or for every dollar that the shareholders invested in the company, right? Shareholders' equity, how much profit they make, or how much net income they generate over that year. Okay. And then ROA, or return on assets, is basically the same net income over total assets, meaning that this measures how much profit the company generates for every dollar invested in these assets, or how effectively the firm generates sales or profits using the assets of the firm. How good you're using the assets of the firm to generate profits. Right? And finally, EBITDA margin is one of the most important ones that people use in finance and other industries. And this EBITDA margin is a valuable ratio because we are removing away from accounting and going towards finance. Right? So remember, this net profit or net income number that we have, they have a lot of non-cash expenses here, right? So this is an accounting profit. But we need to move away from accounting and more toward finance. Net income is calculated by subtracting non-cash expenses such as depreciation, amortization, right? So this EBITDA is earnings before interest, taxes, depreciation, and amortization, right? So since companies have different tax liabilities and capital structures, meaning that they pay different amounts of interest, this EBITDA provides a way to compare the performance of different firms more directly, right? For example, if you want to compare a US car manufacturer such as Ford with a German car manufacturer such as Volkswagen, right? You might face, these companies face different tax rates, they have different capital structures, and they have different depreciations. So net income, which factors in the taxes and interest and all these distortions, is not going to provide a clear picture. right? So what I'm trying to say is that this EBITDA removes the effect of different capital structures and the jurisdictions from tax purposes and non-cash expenses, right? So like Ford company uses GAAP and Volkswagen uses international financial recording standards. So how they treat depreciation and amortization is also different. The amount of taxes is different. Their capital structure is very different, right? So if you want to be able to compare the core business of Ford with Volkswagen, looking at earnings before all of these items is going to provide a better indication of the operations or how effectively they're operating or how effectively they're generating profits, right? And make them more comparable by removing these distorting factors such as capital structures, taxes, and non-cash expenses. I hope you find this video useful and thanks for watching.